This week, we're going to be talking about data tracking. We're going to discuss the basics of where to start. Many people want to track data, but they don't know what to track or where to start or how to even begin. Most folks, they'll print charts, they'll review charts, they'll write notes down, but it's very difficult to review quickly or find averages or find similarities that you can define and then back test it. So the first step here in data tracking, for me, this is what I did. Again, I can only speak from my own experience. And again, I'm not a registered investment advisor. I'm completely speaking out of opinion here, okay? I don't advise anyone to do exactly what I do. I simply just want to share this with you. That way that maybe you can go out there and find your way of doing it. So when I track data with stocks, I want to look at what happens from a big picture standpoint. I don't want to look at each little price pop, dip, anything intraday. I want to remove myself from the equation in the intraday action, and I just want to look at the overall trend on the day and find out its tendencies. So first off, you want to find commonalities and similarities. This is how you define criteria. You hear people say, well, it didn't meet my criteria. Well, they have found commonalities and similarities in these patterns. And the best way to do this for small caps is simply go look at the top percent gainers on the day, right? Review the top percent gainers every day. Save each ticker and the date. That's it. So you're going to end up with something like, let's say you end up with like SLNO and the date was March 15th, 2019. Even if you don't know what happened, you're recording a date that this was a top percent gainer. And you're going through and you're saying, okay, there was also ATOS, and that was on 0318-201. I'm just making up dates here. But you're simply just recording a ticker and the date. And then you can go back after you've collected enough data and start to look for commonalities and similarities in how these tickers perform. If you're long biased or short biased, either way, you can go back and look in history and find this stuff. So you could say that you want to track stuff like market cap. These are all, you see it and you go, man, all these small caps usually run crazy runs. What makes them run? Okay, well, maybe you want to track some fundamental data, which should just simply be like share structure, which is market cap and float. And then you're going to want to track something as basic as volume on the day, because then you can track float rotation. From float rotation, maybe you want to track VWAP at the close. So what that means is, what was the average price traded on the day at the close? The reason why you want to look at something at the close rather than at the open is at the close will give you a summary of the entire day, right? Not the open of the next day. You want to see the summary of the entire day. What was the trend? VWAP, a lot of people use VWAP to determine what the average price traded on the day was. And that helps them give an indication of whether, if that average price is a long, are they underwater or in the money? That can give you an idea of psychology of what someone will be thinking if this happens tomorrow. Then from there, you're going to track basic candle information. So that is going to be the previous close. You want to know where it ran from. The open today, the high, the low, and the close. This is just basic information. And the point to this is that it helps you determine how it finished. And another one that I will add here is position in range. If we have a chart that looks like this, you have a pre-market, a little bit of spike here. Let's say it looks like this, it pulls back, and it's right here, okay? And you've seen that when they break the high of this pre-market top at the open, and it ends up looking like this, and it goes parabolic, and then it pulls back and does this, or wherever it finishes, and then it tanks at the end of the day, whatever it may be. But let's say at this point here in the morning time, you want to test, how does this stock finish when this happens, okay? So you have one in here, criteria now. And our criteria has become pre-market volume. And you're going to define this greater than, and you're going to find something and say, what traded pre-market? I don't know. Well, let's go look it up and find out what it was. And then you set a scanner to scan for volume greater than this amount. And let's say it happens in a price range. Price is between, let's just make an example of 1 to 10 here. And then we have a top confirmed, like a breakout level that you could use at the open if it pushes above it. And now from here, you can test for gap percentage. So gap percentage is nothing more than the open minus the previous close divided by the open times -1. And you can always test for the gap percentage now and find out if it gaps this certain percent pre-market, breaks the pre-market highs, it tends to squeeze. And then you go ahead and you take a look at it and you go, well, in fact, the market cap seems to be something that is key here. And the float seems to be something that is key here. And now what you have is you have a big list of data. You have market cap, float, gap percentage, which is this formula right here, okay? Forgive me, the formula that I just told you right here is wrong. It's previous close minus the open divided by previous close times -1. That's going to give you your gap percentage. Market cap, float, and now you're developing criteria. But people will say, what do I do with this criteria? Well, what you do with the criteria is you now go to a scanner. And let's say you use something like, I use Equity Feed. And what I'm going to put in Equity Feed is this criteria. I'm not going to put the gap percentage because I know that. I'm not going to put market cap or float because I know that. But I'm going to scan for stocks that have pre-market volume greater than whatever. And I'm going to have price between 1 and 10. And I'm going to start looking for the chart pattern. But I'm going to narrow down my scanner to only find what I want to see. I'm not going to scan for everything and then try to find stuff. I'm going to minimize my scan to where it only focuses on what I want to trade, what I understand. I'm not going to go look at a scanner and say, we have 32 tickers that are gapping above 5%. Those gappers above 5% tend to do this. No, that is so broad. You cannot do that. Define criteria that gives you the pattern potential. Don't just trade everything. Don't run a scan and look at every ticker that's got volume and think that there's edge in trading something there. And then guess what you do? You bored or you're worried because you see everybody else making money, and then you go trade it. And then you lose money because you didn't know what was going on. But you thought because it dipped right here, there was support and you could buy right there and it would make money. But you haven't tested anything. You haven't even found a similarity. You haven't even found a commonality. Nothing. You got no criteria besides what? Volume, which is not really anything, right? But I'm going to scan in this scenario for pre-market volume greater than whatever, price between 1 and 10, right? And then I'm going to look at the gap percentages and the market cap and the float. And for the love of God, stop looking at the float on FinViz. Go look in the filings. Learn how to find what a real float is. Protect yourself, folks. Stop looking at FinViz. Just stop. It is so wrong. Most of the time, it is so wrong. That is the one piece of that I would tell you. Learn to look at what a real float is. Take the time. Spend 2 minutes finding what the real float is. Maybe 5 minutes. And really understand it. There's a series on YouTube from a guy that's a really good fundamental guy. And then, of course, if you want to learn that too, you can always ask Chicago Trader. I'm sure he'd be happy to help you. But anyway, so I'll get off my soapbox there. Now, back to tracking how it closes on day one, right? Because you see all this stuff happen, right? And you want to buy here when it breaks the pre-market high. But guess what? You don't know where to sell, right? So here's what you need to define, okay? You need to define 2 things. Time-based exit, price-based exit, okay? You then use those to determine a risk and a target. Risk level is generally a price-based measurement, but targets can be time-based or price-based. And what I mean by time-based is, let's say that this overall pattern, when it breaks this pre-market high right here, and it has this market cap, this float structure, this gap percentage. Oh, and let's go ahead and add in here that it's got some form of a catalyst. And a lot of you are probably saying to yourself right now, well, that pattern sounds familiar. Yeah, a lot of people teach this pattern. It's called pre-market breakout. And a lot of people teach it, but not a lot of people test it. They just take their word for it that it works. Test it. Go out there and look for it. Just because somebody on YouTube told you to trade a pre-market breakout does not mean tomorrow you need to go trade a pre-market breakout. You learn the pattern. Oh, that pattern exists. Somebody likes it. Somebody makes money off of it. Oh, well, I'm going to write that down. Let's go track those. Okay, well, I'm going to track the top percent gainers for the day, and I'm going to see if they had any pre-market breakouts. If they did have a pre-market breakout, I'm going to go do this. Or each morning, I'm going to wake up and I'm going to run my scanners, and I'm going to look for gap percentages that are this, because that dude told me that it's this gap percentage, this price range, this volume. I've already got his criteria, so why don't I run that scan in the morning, take a screenshot of it, and see how they finish for the day. Come back later in the night after I went to work my regular job. Come back later that night. And then I walk in the door and I say, hey, guess what? I'm going to spend the next 30 minutes to an hour reviewing all these tickers. I'm going to record some information, and maybe I learned something, right? It's not just, I got to make a scanner and all of a sudden all of this data keeps coming into you and it's just making sounds and dings and alerts and beeps. And all of a sudden you're just pushing buttons and making money. It doesn't work that way. There's a long road. There's a long road to get there. But it's so valuable once you have it. it cuts down your learning curve so fast, so fast. You don't need to spend years learning stuff. You use data to learn it quickly. So now what we want to define here simply is this, is if we buy on the break here, okay? Now, here's the thing I want to define, okay? You have to think systems-based, okay? You got to think like a systems-based trader. So a systems-based trader will define a system using a reference point, right? So a reference point of entry. A lot of people that trade a system will use this bar close, okay? So I'm just going to write this, all right? Buy if this, or sorry, let's do it like this. Buy this bar close if bar close is greater than pre-market high. I hope that makes sense how I'm writing it like you would code it. That is how you can define it, okay? One more thing I want to add up here is time-based entry. And the reason why I want to add a time-based entry is this little phrasing right here, okay? So a time-based entry is wording like this. Buy this bar close if bar close is greater than pre-market high. So what that would look like on a chart is simply this. You have, let's say, like this candle here is the, you know, the pre-market high, right? We got a candle like that. Let's say that that's the high, right? Pre-market. And then all of a sudden, you know, the price closes here and then it kind of trends down for a little while and then it goes like this and then the open comes, right? Now, remember, this is our breakout point, right? Okay. But here's what happens at the open. You can't assume entry at the breakout level, right? You may not get it. You may not get that price execution. There's slippage, right? We've all tried to enter somewhere and all of a sudden price just skips up on air and we're like, well, it's 10 cents above the breakout level now. Do I really want it? So what you would use in this case is this bar close, okay? And when you're testing intraday data, do yourself a favor. And only use a 5-minute chart, the smallest, shortest time frame. Don't go to a 1-minute chart because you're going to have, you know, like a wick go through and you're going to be like, oh, I bought it. But you never know. And then the bar closes like way down. Use a 5-minute candle, let it close above it, and then test from that close what happens, okay? Because then you can define if there's edge, right? So back to my point here. So we now have an open, and let's say it opens here, and it pushes, okay? Now, we have our breakout. Let's say we got a little wick up here, a little wick down there, make it look real. So now, our entry point on our testing is the close of this bar, not the breakout level, okay? Because that's unrealistic. It's unrealistic that you're going to get this entry every time, okay? Unless maybe you have an order waiting with a slippage factor in there, you could do that. But that's you trading, not testing for an edge, okay? So now we get this bar close, right? This bar closes here. This point right there, and you can look at the candle and say, close is 250. Breakout level, 230. Okay, you're buying 20 cents above, right? Now, what I want to define is this. I don't want to define anything else except for a time frame after the entry, okay? And now I want to look at a chart like this, and I want to know two things. After the entry point, right? So the entry becomes this bar close, right? Which is much easier than being able to buy at a breakout level. You can just buy at the close of this bar, watch the clock. Okay, 3, 2, 1, I'm in. And it's easy, right? You're going to, be within a couple cents or something like that, but it's going to be close. And that's the point when you're trading it live. But you don't want to trade it live this way, maybe not, but you want to test it this way to find out if there's real edge here, because you can't assume perfection. Now, what we're going to test after entry, okay? We're going to test the highest high and the lowest low. Time of high, time of low. Now, the reason you want to test the time, it gives you an idea for a time-based exit. There is such thing called decaying edge. Edge, or probability of success, decays over time. You don't always have the same edge right now at this very second that you do 2 hours from now. It decays over time, or it could increase, just depending on the chart. You never know until you test and you find out what amount of time it usually takes for the trade to work. Now, you also want to test for risk levels. The most common risk levels in these scenarios are going to be low of day, call that LOD, open. So if it falls below the open price on the day, like the daily candle turns red, is that key? You don't know. I don't have a clue. Let's test for it though. Risk levels, again, to test is low of day, open price, and also if there's not a big gap percentage, previous close. You could test for that. Or breakout level. If you want to use the breakout level, that price can't go back below the breakout level, test to see if that works. And how you do that, I will go over in next week's video. But for now, what we're going to look at is just these ideas. We end up with a bunch of columns on an Excel spreadsheet. We end up with all these different things to test for. And we start asking questions. Is lowest low less than low of day? Is lowest low less than open? Is lowest low less than previous close? That's probably going to always be a no. But, just in case. Yeah, there's some cases where it is true. Is lowest low less than breakout level? This gives you an idea of this question. What is a reliable stop? If you don't know what a reliable stop is, how do you know how to choose the stop loss? Is low of day the most reliable? That doesn't give you a lot of risk, but still gives you good outcome. It gives you an opportunity to profit. or is open price, or is the breakout level? Does it have to hold the breakout level in order for you to hold? And now what you end up testing is the overall trend for the day. Now, instead of you caring about all these little pops and all these little dips, you know that, let's say, for instance, based on our chart here, you know that most of your edge after your entry point only lasts for, let's say, like an hour, right? So your maximum hold time is an hour. So either you've hit your target or you exit after your position is open for an hour, because you know that chances are after you've been in this for an hour, the interest from the demand or the buyers goes away. They lose interest after, an hour of after a breakout level. Now you have a time-based exit. The time-based exit does not overrule the risk level, and it does not dictate your price-based exit, okay? Now you're going to test and look for a target price. The reason why you want to define a target price is now you discover this. Let's go ahead and shrink this text down. Now you find the highest high after your point of entry, right? And now what you want to ask is a basic question. After your entry point, oh, that's a really bad curve. After your entry point of that bar close, let's actually color that different. Let's color it green. You're going to ask, not in green text, what percentage? So that's going to be this formula. Your target is going to be equal to your entry minus highest high divided by entry times -1. Times -1. And the -1 there is there so that you always do the formula the same way. You don't have to remember, if the value is supposed to be negative or if it's supposed to be positive. If you do it this way, the value will always be true. It will always be a negative if it's falling. It will always be positive if it's an increase in price, negative if it's a decrease in price. So think of it like this. It's always from your start point to your end point divided by your start point times -1. Okay, so I'm just going to put that up here as well. Percent gain is equal to start point minus end point divided by start point times -1. That will always give you your correct percent gain, whether it's negative or positive. So this video has been kind of long here, but this is just the beginning of data tracking, okay? There is so much more to track. There's so much more to learn. Next week, we're going to jump into another topic, and we're going to actually apply this into Excel. And I'm going to take all of what we talked about right here, and we can start to develop a system that trades based on our ideas and tests to define whether we have an edge or whether we don't. So thanks for watching this week, guys. I hope it has been very informational for you. If you have any questions, please feel free to send me a message. Take it easy.